Good evening. It's my privilege to welcome you all to provide an update on the annual results for Reliance Industries Limited. 18-19 has been a landmark year for us with several records which I'm proud to share with you. Starting with the big numbers, consolidated assets exceeded 10 lakh crores as of March 31, 2019, a big milestone for us. Consolidated revenue exceeded 6 lakhs crores, another milestone for us. We had record earnings from petrochemicals, geo and retail. Our consolidated EBITDA was 92,600 crores with an exit rate of nearly 1 lakh crores a year. And our consolidated net profit was just below 40,000 crores, up nearly 13% year on year. Several other milestones. We had the highest ever production in our petrochemical business. As far as geo is concerned, it crossed 300 million subscribers and also had a new milestone in crossing 15,000 crores of EBITDA. Retail had another very strong year. Revenue crossed 1 lakh crores comfortably, and total stores under operation crossed 10,000. Our energy businesses remained very resilient despite a volatile operating environment, and standalone segment EBITDA was up 12%. Our consumer businesses now account for just under 25% of consolidated EBITDA, and we have taken another major step in terms of demerger of our fiber and tower assets, creating the path for an asset-light geo and value creation for our shareholders. Let's now reflect on the macro trends that we expect in 2019. Firstly, everything that we have seen and heard so far points towards slower global growth, both in US, Europe and China. The China numbers of growth at 6.6% are supposed to be at a 28-year low. Closer to the factors that affect Reliance's business, as you probably know, crude prices were up and averaged nearly $70 per barrel in 2018, putting a pressure on the crude markets, which became tighter towards the year end. We also saw new capacity in cracking come up globally. US with 3.5 million tons of new cracking capacity led that. As far as refining is concerned, we saw record refinery runs in the US hitting 98% at times, leading to record gasoline production and putting some pressure on gasoline margins worldwide. Light-heavy differentials were also narrower, which affect complex refining simply because of lower supply of heavy crudes from Venezuela and Iran. We are very levered because of our consumer business to consumption spending in India, and that was really good, and we expect a 12 to 15% growth in that even in 2019. As far as petrochemical demand is concerned, we saw 7% growth in both polyester as well as polymer chains, giving us confidence that we will continue to benefit from our market leadership in India in both these chains. A quick summary of our consolidated financials. Revenue at 6,22,000 crores, up 44.6% compared to last year. Record production of petrochemicals, 22% higher crude prices, but most importantly, the revenue growth in retail and digital services gave this big jump of 44% over last year in revenue. PBDIT on a consolidated basis up nearly 27% to 92,656 crores, again primarily coming from our petchem business and the consumer businesses. Depreciation was higher at just over 20,000 crores, 25% higher than previous year, coming out of new capacity in hydrocarbon businesses and also increased depreciation charge from our digital service business. Same story for finance costs, jumped up from 8,000 to just over 16,000 crores as we commission new capacities both in our energy and consumer businesses. As a result, net profit up from 35,000 crores to nearly 40,000 crores, up nearly 13%. Net debt, an important measure, is up only 9% from 1,41,000 crores to 1,54,000 crores, arising both because of earnings and because of the deleveraging obtained through transfer of debt to fiber and tower companies. Adjusted return on capital stays stable at 13.5% and is among the highest in our global peer group. A quick look now at our standalone financials. Revenue crossed 4 lakh crores standalone, up 27% year on year, a combination of oil price increase of 22% and higher volumes from petrochemicals. PBDIT up 12.9% from 60,000 to 68,000 crores. This again, as we will see later, is a combination of both higher volumes as well as an uplift in the integrated polyester margins. Depreciation up 10% to 10,558 crores. Interest costs nearly double from 4,600 crores to 9,700 crores. And net profit, a record at 35,163 crores, up 4.6%. Let's look at where we got the earnings from. And when we look at segment EBITDA this year, refining and petrochemicals combined account for 70% of consolidated EBITDA. Organized retail accounts for 7%, and digital services account for nearly 18%. So 25% from digital services and 70% from petrochemicals and refining. Last year, the contribution of consumer businesses was only 13%. And if we look back to a history of 5 years, the contribution of consumer businesses has grown from just under 2% in 2015 to nearly 25% in 2019, reflecting clearly what our emphasis has been in the past 5 years, which is to dramatically grow our consumer and technology business. As far as petrochemicals are concerned, for this segment, we had a 37% growth in revenue, up to 1,72,000 crores, led by higher volumes and higher feedstock prices. EBITDA margin improved by 130 basis points from 20.6% to 21.9%, and the EBITDA itself at 37,645 crores was a record in our history. Production was up from 32.5 million tons to 37.7 million tons, up 16%. As we look at our major products in the petrochemical business, polyethylene and polypropylene margins were softer by between 12 to 15% on average through the year, simply because of new capacity globally and higher feedstock prices. On the other hand, our polyester chain, particularly paraxylene and PTA, was strong, and we saw margins better by 35 to 40% as compared to previous year. The integrated polyester chain margin now crossed $800 per ton compared to only $720 in the previous year. The benefit of our new cracker and paraxylene capacity have given us the 16% volume growth in this year. We also completed our ethane project, including the pipelines in India, and this year's performance is clearly a function of both the higher volumes as well as the better polyester chain margins. Refining had a relatively softer year this year. Revenue was up 28.3%, but entirely on the back of higher oil prices. Throughput was 2% lower because of planned turnarounds and shutdowns. GRM dropped from $11.6 per barrel to $9.2 a barrel. Softness in complex refining, but we managed to maintain our premium over Singapore complex at $4.3 per barrel for the full year. As we look at each of the individual products, naphtha turned from positive to negative, reflecting softness in the cracking market. Gasoline dropped dramatically from $14.6 per barrel on average to $8 per barrel on average, and in fact in the last quarter at several times was zero or negative in the Asian margin because of the oversupply. Diesel margins and aviation fuel margins were marginally better, but that improvement could not really offset the weakness in light distillates, which is naphtha and gasoline. As far as our upstream business is concerned, it was fairly flat for this year, both in revenue and EBITDA terms. We had declining production in domestic by about 25% lower, and in our shale gas business, production was 34% lower than previous year. Revenues were a modest 4% lower than previous year, made up by higher oil and gas prices, both domestically and in the US. Our retail business had another year of hyper growth. Revenue was up 89% from 69,000 crores to 1,30,000 crores. Strong growth across all consumption baskets. EBITDA went up from 2,500 crores to 6,200 crores, more than doubled, coming on the back of core retail margins improving. So we had hyper growth in revenue along with EBITDA margin expansion. So for all of retail, EBITDA margin improved 100 basis points from 3.7% to 4.7%. But when we look at what we call core retail, which is fashion and lifestyle, grocery, consumer electronics, margin improved from 6% to 7%. We have now a remarkable footprint across the country. We opened 2,829 stores during the year, about 8 stores every single calendar day. We are now present in 6,600 towns, and we added 25% of retail trading space, the highest that we have added in any year, and we added 4.3 million square feet in 1 year, taking the retail trading space to 22 million square feet. We operate more stores than all other retailers put together. Our revenue in the last 12 months is more than all other retailers in India put together. We are among the top 10 fastest growing retailers in the world. We had over 500 million footfalls last year, a growth of 44%. We now have over 50 million loyalty customers, a growth of about 35% year on year. And Agio.com had more than 300 million web visits and doubled its product catalog to over 130,000. Let me now talk about Jio. The first big landmark, as I stated earlier, was that subscribers crossed 300 million during the year. We had a net add of 120 million subscribers in this year, needless to say, far more than any other operator in India. Our exit ARPU in this quarter was 126 rupees. Our revenue for the full year, nearly 39,000 crores, up 93% compared to last year. Our EBITDA crossed 15,000 crores and is up 124% year on year. And we have a net profit of 2,964 crores, which is 4x of the net profit in the previous year. Our EBITDA margin at 38.9% is industry leading and improved by nearly 600 basis points year on year. As far as data traffic is concerned, in voice, we saw 89% increase in voice traffic year on year. And in data, we saw 85% year on year increase in the data on our network. Our subscribers have voice usage of 823 minutes per sub per month. It's the highest voice consumption on any network. And our subscribers use 10.9 GB per month of data, much, much higher than any other network in India. We now have leadership in AGR market share, where we are now approaching 40%. And we are now the number one operator in 13 out of 22 circles. In this quarter, we had a gross add of 33.2 million subscribers and a net add of 26.6 million subscribers. In terms of our network quality, we continue to have the best download speed, 20.9 Mbps, nearly twice the next operator, as measured in February 2019. We continue our commitment of 100% network availability, and our monthly churn at 0.75% is, we believe, the lowest in the industry. Our customer engagement continues to grow, as you can see in data usage at 10.9 GB per month and in 823 VoLTE minutes. We continue to improve coverage and capacity on our network with a target to get to 99% of coverage across India. On our network, video usage is 500 crore hours per month. The Den and Hathway acquisitions are now complete. We have demerged our tower and fiber assets into two SPVs. Ownership of these SPVs have now been transferred to SEBI-registered infrastructure investment trusts with independent governance structure. And this, as I said earlier, is a significant step in leveraging as well as right capital sizing of our digital services business. Let me just share with you all how we are thinking about this year. We think that the momentum in terms of the positive tailwinds in terms of petchem margins will continue into this year. On refining, we are constructive. We have already seen a sharp rebound from the zero or negative gasoline margins to now nearly double-digit margins by the middle of April. We are seeing that IMO 2020 should be good for complex refiners and give us a leg up in middle distillate margins in the second half of the year. We expect the hyper growth in retail to continue, both in terms of our footprint, in terms of customer value, and in terms of revenue growth. And as far as Jio is concerned, again, we think that the momentum of customer additions will continue into 1920, and fiber to home as well as integration of Den and Hathway will take Jio to homes in an accelerated fashion. Thank you very much, and I look forward to talking to you all again in a quarter from now.
What is the meaning of this word suspense?